Chapter 15, Bond Valuations. And the basic concept with bond is that for corporation and for government, they use bond to borrow money from the investors. So from accounting, you learn that asset equals to liability plus equity. And from a business perspective, how firm can raise money to finance their project is that there's two ways. First is through the equity method, which is issuing shares, issuing common shares or preferred shares, or they can borrow money. And how they can borrow money is through issuing bonds. So that's why it is important for you to understand bond, because in the future you're going to be working for a company. You need to understand how firm can raise money for a project. And there's a bunch of terminology that you need to know here. We have the face value. Face value is the amount owed to the holder of the bond when it matures. So that is similar to your future value. So in most cases, your face value will be your future value in most cases. And then the next terminology is your bond rate or coupon rate. So bond rate or coupon rate. So bond rate is denoted as your B, bond rate. And that's the rate of interest paid based on the face value of the bond. So we use the bond rate to help us calculate the PMT, the payment amount. And the next important definition that you need to know is cash price. Cash price equals to market price plus the accrued interest. So cash price is the total amount paid for the bond, and cash price includes the market price plus any interest that is accrued. So accrued interest is interest that you have not earned, but you're still receiving them. That's what the accrued interest means. And then market price is your present value of the bond. So the present value of the bond plus any accrued interest is your cash price, is your total price paid. So market price is the present value. Accrued interest is the interest that you did not earn, but you're still getting them. So you add those two amounts, you add the present value of the market price. Market price is the present value plus the accrued interest. That will give you the cash price, the amount that you're paying. And when you're buying or selling a bond, you could be selling it or buying it at par. You could be buying it or selling it at a discount or at a premium. And how you know which situation you're in is you compare your purchase price with your principal amount. Purchase price is your present value. Principal amount is your face value. If the purchase price is equal to the principal, your face value, then you're buying the bond or selling the bond at par. When your purchase price is less than the future value or the principal, then you're buying it or selling it at a discount. And that makes sense because your purchase price, what you're paying, is less than the principal amount. So you're paying less than what is stated in the contract. So that's why you're buying or selling at a discount. On the other hand, when your purchase price, when your present value is greater than your future value or your principal, then you're buying it or selling it at a premium because what you're paying is greater than the principal amount. So you're buying it or selling it at a premium. So the example that I gave you here in the table 15.1 is that we have the face value, $10,000 for the three cases. When your purchase price equals to face value, then you're selling it at par. In the second case, we have your purchase price is less than your face value. Your purchase price is $8,800. That is less than the $10,000 of face value. So therefore, you're selling it below par. So therefore, you're selling it at a discount. Last scenario is we have your purchase price is $11,000. That is greater than the face value. So therefore, you're selling it above par. So you're selling it at a premium. So comparing the purchase price with the face value will always work. It will tell you whether you're selling at par, at a discount, or at a premium. Another way to look at it is comparing the bond rate with the market rate. And that works most of the time. And from an algebraic perspective, how we calculate the purchase price of the bond is that there are two cash flow that we're receiving from the bonds. The first cash flow is the present value of the redemption price. So what this is saying is that at the end of the contract, we're getting the principal value back. That's the first cash flow that we're getting, which is your FV, the face value. And then we're discounting it back to the present value. And then the second cash flow that we're discounting is your interest payment. And this is what this formula tells us. To calculate the purchase price of the bond, we have two types of cash flow. The first one is the face value that we're getting at the end of the contract. And then the second cash flow that we're getting is the periodic payment that we're receiving each period as interest. And the next definition that you need to know is sinking fund. And sinking fund is basically payments made at periodic interval to provide desired sum of money in the future. So basically what we're trying to do is we're trying to put money into the account so that we can save enough money for the future. So what that means is that in most cases, our present value is 0. We have our PMT, which is our payment, periodic payments. And then we have our desired sum of money in the future. This is our future value. And that's sinking fund. You're saving up money periodically for future uses.